Good morning, everyone. Welcome to the Deferred Compensation Advisory Committee meeting. It's Thursday, January 26, 2023, and it is starting at 10:12. We will move on to the agenda. Ms. Strange, are you doing roll call today?
I am. Mr. Wilverding,
Here.
Ms. Hopkins,
Here.
Mr. Woolcamp,
Here.
Ms. Babb. For the record, we'll show Ms. Herman, Mr. Canepa, and Mr. Keokum absent. Thank you.
Thank you. For our committee members to know, we do have a new committee member, our Board of Supervisor, Paul Canepa. He will be joining us at the next quarterly meeting. Supervisor Rickman is now the chair this year, so he will not be part of the Deferred Compensation Advisory Committee moving forward. We now move on to the approval of minutes for the quarterly meeting of October 27, 2022. Do any of our committee members have any edits or comments regarding the minutes? If there are none, if we could entertain a motion and a second and a vote, it would be appreciated.
I'll make a motion to approve.
I second.
All those in favor, say aye.
Aye.
All those opposed? Thank you.
Thank you. We're moving on to public comment. Is there anybody in the audience that wishes to submit public comment? Ms. Strange, do we have any email public comment?
No, there's no public comment.
Thank you. So we'll move on to our first informational meeting. We have a program status report for the fourth quarter of 2022 from Nationwide.
Thank you, Chair. Can you all hear me okay? Yes? Okay. Great. And can you see the screen okay? I'm going to share my screen and bring
We
up the
can.
information.
Thank you.
Excellent. How's this?
We can see it. Great. Thank you.
Terrific. So have our update in a couple of different parts. I'm going to spend the first few minutes going over the quarterly information, and then we have Greg and Brenda in the room, which will give more of a field update for the committee. So I'll start with just a snapshot of the plan where it ended the fourth quarter. And as you see on the screen in the middle, we have the 401A, we have a section or column for the 457, and then we have our totals on the right-hand side. And so the quarter started at right around 469 million combined, and then we added contributions into the plan. We subtracted off distributions, and we'll talk about each of these in a little bit more detail. We subtracted off fees and loans, added in other activity and market gains and losses, and the two plans finished the year right around $487 million in total assets. We're going to take a deeper dive into just the 457 plan, and then we have a couple of slides on the 401A plan. But for the 457 plan, we have the beginning balance at the end of the third quarter, and then we had about $6 million in new contributions. Less, we had about $10.4 million in distributions for the quarter. Then we subtract off fees and then new loans, and then we add in the activities with gains and losses. So the 457 plan itself finished the quarter at 464. Other data points of the 457 plan we have, I'm just going to go across the screen from the top left to the top right. So we have the balance with the quarter change. So we were positive 16.3 million from the quarter prior. That includes that's net, so that includes everything that we talked about. For outstanding loans, there's $2.6 million of outstanding loans on the books with Nationwide. Your self-directed brokerage account balance, this is with Charles Schwab, ended the quarter just under $500 million. We have 6,522 participants in the plan with a balance. That's a quarter change from third quarter to that's a positive 164. Your average balance is 71,342. Again, it's up from the prior quarter. The prior quarter was right around 69,636. So again, we're seeing some positive trends with the increase in market gain. We had 175 new enrollments, and we had the exact same number the prior quarter. So no quarter change, but again, a very good number of new participants entering the plan. We looked at contributions, and we'll take a deeper dive on that here in a couple of slides. And then we had loan payments received back to the plan. And then we had some rollover transfers in from, these are from participants that move their accounts from outside into the San Joaquin County plan. And then distributions, again, we'll take a deeper dive into distributions and also loan disbursements and rollovers too. So, but just wanted to cover really, really briefly the number of participants, again, with a balance of 6,522. We've talked about the average balance. We also share what we call e-delivery. So these are the participants who are receiving electronic statements and are not receiving paper statements. So we're right at 66% of this number on the upper left are receiving their statements electronically. We're trying to drive that percentage higher with more digital adoption, but we have 4,271 of your participants opted in for e-delivery. And we also share balance by age group. And so you can see that as your participants are aging, like most plans, the average balances also increase. And you can see that the 60 plus category is the largest. And it's also the same with counts by age group. So we have, again, the 30 and unders, and then we have each corresponding decade on top of that. And you can see that with your plan, as your participants age, they are involved with the plan more than the younger participants. So just a little bit of a deeper dive into the contributions itself into the plan for the fourth quarter. The total amount was just under $6 million. That includes salary contributions. So this is cash flow from paychecks of 4.3 million. And then we had some rollovers in from outside the plan, as well as transfers in. The transfers in were just 457 only. Rollovers in were sort of all money types. And then we also track how many participants are contributing to the plan. And so in the fourth quarter, we received payroll contributions from 3,408 participants. There was no change from the quarter prior, so the number was the same. And then on the upper right, any of the blue columns, that's the fourth quarter. And so this was just contribution activity. And so we have the amounts, and then we also have the totals for all of your participants. And so we break out all of the contribution types that Nationwide receives as a record keeper. And again, most of it was just simply salary deferrals and some transfers in. And then on the bottom right-hand side of the screen, we also have our Roth information. And so we have just over $4 million in Roth assets, and we have 643 of your employees have chosen to defer money into Roth. And so that number is growing steadily each quarter. I mentioned distributions. So the total number of distributions for the quarter was 10.4 million. This includes rollovers out, which made up about half of that amount. So these are people that simply terminate from county, and then they roll their money out of the plan. It goes to many, many sources. And then we had transfers out too. That's just a little bit of money that just went to a new 457 plan. And so when it comes to distributions, we have the amounts in the blue column. And then on the far right-hand column, we have the totals of each distribution activity. So you can see on the right-hand column, we had just the big numbers. External plan-to-plan rollovers, about 26 of those. And then RMDs, those are the required minimum distributions. We had 312 of those. And then termination, that just means that these participants, 175, terminated from the county and just took a withdrawal in cash. And so those are the major numbers for distributions. But I'm gonna pause and see if there's any questions from the committee before I continue.
We do have a question. Go ahead and unmute your microphone.
I think I did. Okay. It's my common question. Why are so many leaving? Is there something we're not saying, that it's not secure enough or it's not going to make enough return? But it's always, it started out with $1 million every quarter, and now it's up to $5 million. And it's just, what are we not saying, or what are we not providing that people need to leave?
Well, our main efforts obviously are to conserve assets in the plan, and Brent and Gray can also speak to it. But these participants are simply rolling their balances, or at least half of the money was taken in cash, and then the other half was rolled to a new provider. So some of those would be new jobs, Some of those would be maybe some pressure from a financial advisor. And so we haven't really researched the whys, but we're really researching the facts of the plan, this, the overall stats. I don't know, Brenda, if there's color you can add to that question, but our again, main efforts are conservation at all costs. We want to keep the money in the plan. We can't keep it all, but we, want to do our best to try to conserve as much as possible.
Brenda, if you have something to add, unmute your microphone, please. Thank you.
So I got a call from a retiree that lives out of state, and he has about 20 of his buddies in the same area. And he reached out to me in regard to the fact that interest rates are higher now, and they have the ability to get CD rates somewhere elsewhere outside of the plan versus what our fixed account is offering. So one of the things that I lifted up to John, and I think maybe he mentioned to you, Tammy, was there might be an opportunity to maybe expand our self-directed brokerage account to add something like a CD option. I know we've always limited it to mutual funds, just in the effort to keep things not too high risk. But there is an interest in that, and we could sort of provide that opportunity for people who may not know that it's available. And of course, I would need to drive some education surrounding that.
Can I jump in about that? 'Cause I was going to ask my question later in the presentation when we got to Vincent's portion. But to piggyback on that, we're looking at $168 million as of the end of December that's in the fixed fund, the guaranteed interest, whatever you want to call it, which is at what, 2.45? You maybe not right at this moment, but last quarter, you could have gone out and grabbed handfuls of T-bills in the 4.5 range. So it would have made all the sense in the world to have liquidated your thing, rolled it into something else where you could buy direct T-bills like in a IRA, and then just go out there and ladder them at 4.5. That's almost double the money Nationwide's paying us to leave the cash parked in there. So I think as the longer we see this divergence, if you will, where I can go out to the marketplace, buy a treasury bill or a treasury note for 4%, or I can leave my money in here and get 2.45. And my guess is, and maybe I'll put this to the Nationwide folks, is you got to be making a killing on this spread right now. So that could be a part of it.
Well, that's
So
interesting.
there's
Go ahead.
Yep, sorry, please.
So one of the things that we covered that I've seen over the years is we've had a lot of people come to us about the fixed rate, and fixed accounts tend to move sort of like a cruise ship. They do longer term instruments in terms of investing. So it takes a long time for the impact to be seen in something like a stable value account. So that's why people are kind of turning to CDs or turning to I-bonds or things that are more shorter term. Those are receiving the benefit of the short-term interest rate changes. So.
Yeah, I can speak about the Nationwide Fixed Fund. Their duration on the fixed fund is roughly seven years, and the portfolio turnover takes about 10 years to turn over every investment in there. I know that the market, let's kind of rewind 2 years ago when CDs were paying 0 and our fixed fund was paying in the 3 to 3.5 range. And so we totally understand market conditions. We totally understand the history behind CDs, where they're flat, they spike, they come down again. We get all that. And our fixed fund is really not designed for short-term market corrections or short-term market investments. We design it for a little bit of a longer period of time. And we're well aware that you can go out to a bank, get a CD, you can get treasuries, and get double that amount. We're totally aware of that. So that might be a hindrance to the plan, but it is invested more conservatively. It also has to be liquid, where it's benefit sensitive. So if a participant wants a withdrawal, we have to keep that liquid at all times. And so we have to also account for that. But we totally understand what you're saying. We totally hear that, and we're aware of that. And then what Brendan mentioned is that with self-directed with Schwab, they do allow treasuries and they do allow CDs. If that's something that the committee wanted to entertain, we could update the Schwab account to allow for those investments if that's something that wants to be discussed maybe in a future meeting. But that is an option too. If you wanted to keep your money in the plan, that would always be an option to get that through Schwab if the committee wants to expand the universe of investments.
Thank you. Were there any other questions for John?
Right, so just a couple other pages on the report. So, and Vincent will also talk about the assets in the plan, so I'm not going to spend much time on this, but we have, and again, we're looking at the blue columns. So we have fourth quarter balances for all of your assets in the plan. So, and then we also have participant counts in all of your asset classes. And then we have allocations as well by percent. And so if you wanted to know where the money is currently sitting in your plan, this is where it's sitting. So if you look at the far right-hand column of the screen, this is just a simple summary, but 18% of the assets are in target date, and then about a third of the plan is in fixed assets and cash. About almost another third is in large cap mutual funds, and then the rest is spread out amongst the other asset classes. We also on this page summarize balances by age group. And so we look at all of your asset classes again by age, and we look at the decades, the 20s all the way up to 60 plus. And then this page looks like a lot, but this is every single investment option in your plan. You're going to see this again from Vincent, so I'll go and skip past this. But this is showing every single fund, all of your balances in each fund. And again, you want to look at the blue columns by percent, and then also the total number of participants that have money in each of those funds. I'm going to finish up with a couple other slides. First, we wanted to take a little bit of a deeper dive in loans. If you look at the upper left, we have your total active loan balance. So these are loans owed to the plan, but 2.4 million. There's 233 current loans active in your plan. We had 40 new loans last quarter. We had 46 the quarter prior, and 8 of those loans in the fourth quarter were paid off, and Nationwide received about $208,000 in loan repayments. And then the rest of the information on the screen is just looking at active loans by age group and active loan balances by age groups. You can see which age groups are borrowing, and then the average balances that are on the books for each of those. And then we also have total loan counts. So again, we have 233 active loans. Most of those are general purpose loans, so 230. There's also 3 loans for primary residence. The difference is just in the length that you can pay those loans off. And so a general purpose loan is anywhere from 1 to 5 years, and then a primary residence loan can take you out to 15 years. And so, but again, most of the loans in the plan are what are considered general purpose. And then just wanted to finish up with our digital adoption screen. So this just shows how many of your participants by percentage have e-delivery. So again, 2/3 are receiving electronic statements. A third of your participants enrolled online. A third of your participants took an online distribution. So Nationwide has the ability to either offer forms, or your participants can take withdrawals directly through the website by logging in. And then 89% of all of the participants that Nationwide record keeps have an online account. So this number on the bottom right, that's very, very high. We really like that. It means that your participants are enjoying the Nationwide website. They have accounts, they're logged in. And that's another one of Brenda's focuses. So when she meets with your participants, she will also encourage online account usage, and then the various Nationwide tools that are available to your folks. The rest of the slides are talking about the 401A. I won't take much time covering the 401A. I'll just show you the summary. So this was your beginning balance at the beginning of the quarter. And then, of course, we factor in all of the contributions, distributions, gains, losses, and your 401A plan finished the quarter at 22.6 million. So again, I'm going to pause and see if there's any questions from the group about any of the data. I only had one other item to discuss, and that was our virtual courtyard. And I have a PowerPoint presentation that'll just take a couple of minutes to discuss that, but wanted to pause and see if, again, there's any questions from the group.
I just have one question. Before I ask it, I'll make a comment, and that your online, the whole online experience is great. I got to tell you, I really enjoy being able to get in there and look around. You're able to get your deductions. If I want to increase my deductions through my payroll, I don't have to deal with payroll. It's easy to move things around. it's fairly flexible in terms of the amount of times you can move money between funds. It's not as super restrictive as we'd experienced previously. The question that I have is on the fund's performance. They give the, you know, the inception, 10-year, 5-year, 1-year, and then year to date. I notice in January, year to date still seems to be the prior year, and I'm wondering how often is that updated monthly, or how frequently is the year to date column in that performance updated?
So I lean on my team for that. I don't know specifically. I would guess either monthly or quarterly, but if Brenda and Gray don't know, we can definitely get you an answer.
It'd be helpful just so I knew what I was looking at, and, you know, I just keep watching to see when the numbers change. I guess I'll figure it out when it finally jumps. I'll go, oh, it must be then.
Yeah. I'm not sure, Brenda, if you're aware of that section and how often the returns are updated.
I believe it's monthly, so
Okay.
it could just be lagging a little bit. Yeah.
Quite possible. I think so too. Yeah, but I'll get the full answer and I'll reach back out to the group. But I appreciate the comments. Thank you for that. Right. So the other item that I wanted to discuss is the success that we had for our first 2022 virtual financial wellness virtual courtyard. I shared this with Tammy, and we are absolutely thrilled, and I'll tell you why. So nationwide, for a select few clients, and we have roughly 30 clients in the entire company, all very large custom plans like yours. Back in 2020, we had a few plan sponsors come to us and request a virtual benefits fair experience because our representatives like Brenda could not be there live. They couldn't be on site. And so Nationwide pivoted to a virtual format. So what Nationwide did was we created a virtual benefits fair booth. And I asked for a few of my plan sponsors to get a custom version. And when I mean custom, we take your logos, we take your color schemes from the county logo, and we incorporate those throughout the experience. We use your custom fund lineup. We use Brenda's scheduling link. Everything that they see and that they experience is only for your county. We also have sort of our generic booths that we have available for our 401k clients and our other government clients. But I asked our marketing team, I sit on a marketing committee in our home office, and I asked that we added San Joaquin County to this list of roughly 30 clients that we have and are able to create a custom virtual benefits fair experience. And so we did that for 2022. And up on the slide, hopefully you can see this, but this is a snapshot of what the virtual courtyard looked like for this year. The look and feel changed from the 2 years prior that we've been offering these. But we wanted to share again on the upper left, we have the county logo, the county logo, we have the county color schemes, and then throughout the booth, we embedded videos. We also embedded lots of ways that your employees can interact. And I wanted to share the end results that we had. And I also wanted to compliment and thank Tammy and her staff for sharing the information with their employees. We had exceptional results, and exceptional meaning that the county finished in the fifth slot overall with roughly 30 booths. You guys beat the state of New York, which is our largest customer that we have, a $35 billion in assets. You had more activity and more engagement than they had. It's absolutely exceptional. So what we found was that throughout the 2 months that this booth was open for 60 days, so the booth opened on October 3rd to correspond with your open enrollment, and the booth closed at the end of November. So during the 60 days, we had 1,984 unique employees of the county visit the booth. And so we counted clicks. And they had 10,829 unique clicks on the hyperlinks that were embedded inside that virtual courtyard experience. So again, just absolutely amazing results. this next slide had every single hyperlink that was available to your employees when they logged in the booth. So if you look at the left-hand side, again, unique visits, unique activities, again, those are all of the clicks. We had 497 of your employees watch the welcome video. We had 247 visit what we call the investment smoothie shack, which is where they can learn more about the investments in the plan, like the fixed fund, for example, all of the different mutual funds available to the plan. And then another call out was that we had 121 of your employees want to schedule a one-on-one meeting. And so what they could do is they could actually look at Brenda's calendar and they can set up a one-on-one meeting. And if Brenda wasn't available, they could set up a calendar with our other retirement specialists that we have in our call centers. And we also had 68 new enrollments because of the virtual courtyard. And then we had 41 of your folks attend webinars. So wanted to share the stats, wanted to again thank Tammy, and wanted to just again show you the various pages. I won't take much time here. This is our smoothie shack. This is where your employees could come and learn more about investing. And once again, we embedded the color schemes, the rugs were changed, the colors were changed, all of the various colors throughout the entire booth, the cups, the floors, the chairs, everything was custom to the county. And I'll finish up. The last item I wanted to share was that these are the other plans that we had, not a full list of plans, but a partial list of plans. You can see that the number one booth activity we had was state of California. They have 200,000, I believe, participants in their plan, massive. This is a nationwide branded government for all government clients that didn't have a custom booth. We had the same for corporate. So if you throw those two out, we had state of California, state of Maryland, state of Ohio, the state of Kentucky, and San Joaquin County. And again, you beat New York State, and you also beat a massive plan we record keep called the Hoosier Start Plan, which is the state of Indiana. So I just wanted to take a second. Thank you all for allowing us to create the booth for you, to roll this out for you. And thank you to the staff for advertising this for nationwide. We're thrilled. Our marketing team's thrilled. Our partners are thrilled. And just wanted to say thank you.
Were there any final questions for Nationwide before we move on to our next item? Okay, thank you. Our next item is the fourth quarter 2022 performance report from the highest group. There may be a possible action requested after the discussion. Vincent?
Appreciate the opportunity to present. Glad to be back in Stockton. You should have two reports. One's a little bit thinner, so maybe put that aside. They look similar. I'm going off the December 31st, 2022 performance report. Everyone got it? Okay. I guess the title of my quarterly presentation this time around before today would have been "The Economy and the Stock Market Are Similar but Different." Similar but different, until I saw the GDP number come out this morning, and I thought, okay, maybe we are tracking towards recovery and avoiding this general buzzword of a recession into 2023. Go ahead and flip ahead to page 1. I want to highlight exactly what I mean by some of these economic indicators that we're talking about. One of the things that was talked about early on last year and still is gaining some traction in terms of economic jargon is called recession. The old school definition of a recession is where we have 2 consecutive quarters of GDP numbers that are negative. And GDP stands for gross domestic product. It's the dollar value of all the goods and services produced in a country in any given year. If you recall, the first and second quarter of last year was negative 1.6, followed by negative 0.6 respectively. And again, back to that minor cadre of economists said, aha, we're in a recession. Others said not so fast, because a lot of the other economic indicators are really positive. The third quarter number came in at positive 3.2, and as I said, the fourth quarter advanced number came in this morning at 2.9. Remember, a healthy economy, they call it the Goldilocks economy, not too hot, not too cold, is about 2 to 3%. So we're in line with really, really solid economic numbers. The other part of it too is move over to the upper right. The jobs numbers are still strong. Wages are still strong. Real estate, despite the pullback in high interest rates, are still strong-ish. There's a lot to be thankful for, and that unemployment rate pre-pandemic was 3.5%. Remember, a measure of full employment is a 5% unemployment number, but we did experience the pandemic. It spiked to about 15%. It's since settled back down to a pre-pandemic low of 3.5%. Here in the county, it's a little bit higher at 5.5%, but still locally as well as nationally, very, very strong from a jobs number. Yeah, go ahead.
It's just odd that I hear that Amazon and almost every place that's tech is laying off people. Why is the unemployment rate dropping if they keep saying that?
Sure. A couple things. One is the unemployment rate is a look back or rear view. And the other part of it too is the tech sector doesn't employ a ton of people to begin with. And so when we hear about these, it's generally for more of the headlines. We take a look at the absolute numbers. Even though we're hearing a lot of these big tech giants laying off hundreds, if not thousands of people, it's really a slight impact to the overall economy when you take a look at the overall employment numbers. But, and this is where the majority of economists are saying, the dark clouds are getting darker looking forward, and I'll talk about that as I move down into one of the significant symptoms of headwind to our economic recovery, and that's the Consumer Price Index, also known as the I word. Anyone want to guess? Inflation.
Oh.
We are at 40-year highs. So during the summer, the CPI was over 9% at 9.1%. Remember, the Federal Reserve has an explicit target of a 2% number, so that 9 is really high. We've since come back down dramatically to 6.5%, but we're still very, very high in terms of CPI. And what does the Federal Reserve do in a high inflationary environment? They raise interest rates. And we saw a gnashing in the markets in the first 3 quarters of last year because of the aggressive stance that the Federal Reserve has been doing in terms of trying to tamp down the CPI number through higher interest rates. So take a look at the next page, page 2. The bond market took it on the chin last year in the first 3 quarters. If you take a look at page 2, the chart on the upper left, the second line down is what we call the AG. It's the Bloomberg aggregate. This is a good representation of our bond market. And historically, the bond market grows anywhere from 2 to 3.5%. Take a look at that 1-year number, negative 13% last year, despite the fact that it was up almost 2% in the last 3 months of last year as rates normalized. Jay, back to your point, the year to date of the AG as of yesterday, positive 3.1%. So if you're still seeing some negative returns, as soon as you, like you said, you see that number pop from negative to positive, that's where we'll see the shiny star in the bond market. Moving down into probably halfway, you'll see the Bloomberg US TIPS, TIPS, that stands for Treasury Inflation Protected Securities. That index was up 2% in the 4th quarter, still almost negative 12%. As of yesterday, year to date, positive 2.3% on that TIPS index. And then about 3 quarters of the way down, excuse me, you'll see the high yield. This is a euphemism for junk bonds, negative 11% for the year, despite that 4.2% quarter. Year to date, as of yesterday, 3.7%. So this is basically going back. One of the things that a lot of the economists are looking at is the chart on the upper right. We call this the yield curve. Some economists view this as an okay predictor. I've talked about this in the past because what we're seeing during the near recent past is what we call an inversion. The inverted yield curve is where short-term fixed income products are paying more than longer durated, which generally predicts a slowdown in the economy. I call it an okay predictor because it doesn't predict it 100%, but every recession in the modern era has been preceded by an inverted yield curve. To put it more succinctly, the 2-year Treasury right now is paying about 4.2%, and the 10-year Treasury is about 3.5%. And so again, with this inversion, it does potentially forecast an economic slowdown. A lot of economists are saying we may have a soft landing, we may enter a recession, but even if there's a recession, it might be very, very shallow and or brief. But we'll
Vincent,
see.
could you
Yeah.
explain for everybody who may not understand that, why that inverted yield curve would be existing with the expectation of a recession? Because it's not really intuitive on its face.
Right, right. So essentially, the bond market acts as interest rates go down, the value of existing bonds go up, and the inverse is true. So what we're seeing right now is we're seeing a lot of investors buying up the longer yield, and when the price goes up, the yield goes down. Basically, what that means is they're essentially pricing in a slowdown of the economy where investors are looking out longer in the yield curve and buying and locking in to alleviate some of this short-term risk that we're seeing. The other cruel part of this is it could become a self-fulfilling prophecy, meaning if I'm a chairman or a hiring manager and I see these, I could look at this and say, gosh, the forecast doesn't look good. I'm going to decrease my hiring, decrease my spending, and become part of this almost vicious cycle just because of the numbers. And so that's why all those dynamics are in play with this okay predictor of future economic forecast. Does that help?
It does. I might add one other thing,
Yeah.
just to try to maybe summarize it
Yeah.
even further, is when a recession happens, what happens is the Fed goes and it drops interest rates in order to boost the economy. As Vincent said, the two of them are inverse, right? The higher the interest rate, the lower the existing bond values drop their face value. And normally they go at 100, and so you see them drop 90, 80, or whatever. And then they go up over 100, 105, 110, depending on how the interest rate goes. So what happens is if I'm expecting a recession is going to happen in the next 2 years, I'm going to pay less interest rate for, let's say in this case, the 10-year for a 3.5, because I'm figuring when a recession comes around, the Fed is going to drop the rates down to maybe 1, and my 3.5 is going to look great. Where if I buy a 4.5% today, I'm going to gain an extra percent, but that'll be maturing right as the Fed drops the rate. And then when it rolls, I'll have all this cash and I'll have to buy at the current rate, which will be 1%, where I'd be better off taking the long view and buying the 3.5% that I could live off of for the next 10 years.
Exactly, yeah. All good, okay. So going back into my crystal ball, taking a look at the futures market, the Federal Reserve, or the FOMC, more specifically, is going to meet at the end of this month and announce on February 1st their next short-term interest rate move. Back to Jay, your point. And given where we are with inflation, there is almost a 100% chance that they're going to raise rates yet again, but only 25 basis points. Remember, the aggressive stance, they were raising it at almost unheard of 50 basis points at a time. Fast forward to March, smart money is that they're going to raise rates yet again at 25 and then hold pat. And then back to your point, maybe with this recessionary looming, given what we're seeing domestically as well as in Asia and Europe, November is where the future market is predicting finally a rate decrease given the inflation as well as the economic landscape. And so we do have a couple more interest rate hikes planned, at least according to the futures market, with a decrease towards late fall. All right, moving back into the markets, page 3, chart on the upper right, the S&P, or Standard & Poor's 500. If you recall in 21, this index was up almost 30%. You can see negative 18% for last year, despite that 7.5% pop in the last quarter of last year. Year to date, as of yesterday, the S&P 500 is up almost 5% at 4.7% to the positive. So nice returns out of the domestic stock market. And then the trend continues on the international side. There are about 45 countries outside the US with an investable stock market. On page 4, on the upper left, the top line is what we call the ACWI, or the ACWI. It stands for All Country World Index minus United States. Negative 16% last year, after a fourth quarter of up almost 15%. As of yesterday, year to date, 8.3% on that All Country World Index. But I do want to focus right here in the middle of the page. I don't know if you can see it. There's 2 purple bar charts going to the left, followed by 2 purple bar charts going to the right. The dark purple is the local currency, and that light purple is due to the strength of the US dollar. And you can see where we are, back to my point about the geopolitics of what we're seeing in Asia as well as Europe. There has been a flight to our US dollar. We are in a relatively strong US dollar environment that's helping and hurting the international investors. So take a look at the 1 year, -7% in local currency due to the strong dollar over the last year. That -7 gets translated into -14%. But that has switched a little bit, and so you can see the 8.72% to the positive is now translated into higher returns because of the very short-term weakening of the US dollar after last year. And you can see that 8% in local currency gets popped up to over 17%. And again, that's just because of the currency diversification. So very, very interesting, not just American travelers overseas, but it also impacts American investors as well as American companies overseas. You have companies like McDonald's and Coca-Cola where they get, excuse me, almost half of their revenue outside the US. So questions, comments? All right, going back to the plan, page 7. Some points were raised earlier with the committee as well as with Nationwide. On page 7, this is the broad overview. Yep, true to form, a very, very high allocation, which is common with our other city and county plans. You have almost 40% in the fixed income category, 168 million just in the Nationwide Fixed Fund, earning that 2.5% or 35.8% of the assets. About 30% in large company, 4% in mid-sized company, 4% in small company. And then rounding out the right-hand column, you have 3% on the international side, investing in those countries that I talked about, 18% in the target date models, and then the specialty, the real estate, which has about 1.5 million, and then the gold and special mineral, about 2 million. And then under the miscellaneous, you have about 500,000 in the self-directed brokerages, assets that we talked about, and then loans just over 4 million. I do want to highlight just one thing to continue because I do have some thoughts on the upper right of page 9. We have talked about this. The good news is you can see.
Hey, Vincent,
yeah.
can I interrupt
Yeah,
you for 1
absolutely.
second? If you flip back to page 7.
Yep.
And you take a look at the first 6 categories here, I'm going to ignore the specialty and the miscellaneous for right now. You know, in the fourth quarter, if any participant, and that's why we do this, right, for our participants, had a diversified allocation of just one of each one of these categories to whatever degree they wanted to have, they did really, really well in this last part of last year, even though the market took a drubbing in the beginning. So I'll go back to when we put this this profile together several years ago. Remember, we went through you did a great deal of work. This thing's held up over this turbulence that we've had over the last 18 months. And to stay the course and be diversified, if folks did that and they had a little extra cash on hand and they deployed it in the fourth quarter, I think they're set up really well right now. So I think we should point that out.
I agree, and I think that's an excellent segue into one of my points with the previous discussion on page 9 on the upper right, where you see this consistent negative cash flow. Now, the nice thing is there are some strategies around potentially stemming that, but here are my thoughts around that is I agree it's tough as a participant when we're overwhelmed with so many other things. We talk about the 2.45 with the fixed account, and I can get whatever, 7, 10, 6 somewhere else. You're chasing the shiny star or whatever. I think going back to the broadly diversified fund, I also think that there's a misconception that I have to take money out. But the other part of it too, and this goes back to your point about this well-diversified, staying the course, rebalance, and deploying excess capital, is by rolling money out, you lose a lot of the tools that Nationwide provides. And so I get the fact that it's compelling to roll the money out, but there's a lot of services, and Brenda is just one face of the Nationwide army, I guess. But I think there could be an opportunity to maybe broaden that, is that there are potential costs of rolling out to try and then capture this interest rate spread that is maybe once in a generation, once in a career, I don't know, but maybe some opportunity that there are benefits of keeping the plan, and the nationwide team is just one part of that. But I agree with you, staying the course, this is not a sprint. Rebalancing and is generally the better course, depending on your risk tolerance and time horizon. The other part of it too is we talked about it, I want to say a couple years ago, but it was pre-pandemic. Don't you remember the retirement? There was a newsletter that someone brought in, and in the retiree newsletter, there was an advertisement of the local credit union. Say, take money out of the 457 and roll it to our credit union. And so there is a heavy marketing machine behind rolling monies out. And so I think maybe we just try and compete with that. I don't know. It's just some thoughts. Because it was asked by you earlier, I wanted to share that. And the numbers bear that out. Yeah. Don't you remember that, somebody? Yeah, okay. The good news is with the turnaround, the average account balance, page 9, bottom right, did increase by about $2,500 to that 70,000 plus figure that is in the book and that John mentioned. Moving to page 11, this is the 401A program. Same investment menu, very different asset allocation, only 20% in the fixed income, about 40% in large cap, and then 22% in the asset allocation models in those T. Rowe Price target date funds. Moving on to page 13, the average account balance here grew by a pretty impressive $7,500 for the quarter, just under $155,000. And then despite a lot of the volatility, I'm flipping ahead to the next section, a lot of volatility to the downside in the first 3 quarters of last year. The plan's in relatively good shape. There is one fund you can see that's showing red, the American Beacon International Equity. This fund has been on our radar for a couple of years. First when they replaced one of the sub-advisors, but to shorten the story, our recommendation is to terminate this fund, and we have a document in case the committee would like to accept our recommendation and look at alternative funds in that international value asset class. I don't want to skip the rest of the pages because of unimportance. I'm skipping only because a lot of the numbers on the next section tied up, and as I said, the plan's in relatively good shape. I do want to highlight, it's punched out on mine, but it's page 22. And this goes back to a lot of the work that we collectively did. But take a look in this era of high inflation, this gold and special mineral fund. Now this is just one point in time, it was the last 3 months. Take a look at the return for the 4th quarter of that particular fund, all up almost 22%, which is pretty phenomenal.
And if you recall, a couple years ago when we evaluated it, there was some talk about throwing that out, right?
That's why I mentioned it, Jay, is yes, there was a contingent that went against our recommendation to decide to keep it. So yes, very, very good forward thinking on the committee's part. Okay, flipping ahead past page 23 into 24, I want to highlight this because overseeing the overall economics or the fee structure of the plans are an important and fiduciary act. For anybody who wants to know, this is just a single point in time, but a good overview of what the participants are paying and really what your consultant is reviewing on a regular basis to make sure that the fees are in fact reasonable, if not competitive. All the funds, this is just the 457, all the funds in the plan are on the left-hand side. The assets at the end of the quarter are towards the middle. The expense ratio is the next column. It's expressed as a percentage because even though the fees are in hard dollar, they're asset-based. And so when the fund manager deducts her or his fees, they just deduct it off the gross return and then report the net of fee performance after these percentages are taken out on a regular basis. The admin fee of 5 3/4 of a basis point or 0.0575% are in the next column. And then you can see on the 2 far right columns, those dollar values. So the fund managers are taking about $1.5-ish million a year. And then the admin fee is about $270,000, again, ish. in any given year, because the breakdown or the accounting of that 267,000 is below. Nationwide collects their 2.25 basis points, the rest 3.5 basis points is about 104,000 and 162,000, again, approximately, or 26,000 quarterly and $41,000 quarterly, respectively. And that's what the plan can use to pay for plan-related expenses. And it's very much is close to the budget.
And something else I would, if you don't mind me diving in again, is if you take a look at the expenses for the equity income Admiral Fund, which is 2/3 to the top of 0.04%, which is one of it's the smallest, I believe. And if you take a look at that fund's performance, it doesn't matter if you go 1 year, 5 year, 10 year, it's been outstanding. And you take a look underneath at the institutional index, I mean, that was 19, I'm sorry. The institutional index underneath it, which is 0.4, I believe that is the cheapest, and if you look at the performance of that fund, it's equally as good. It's interesting how those two strong funds are among the lowest on the lineup from a cost standpoint.
Exactly. All right. Other comments, questions? All right. Hearing none, thank you. I think, again, Jay, another good segue into our second document. Back to the point about the American Beacon International Value Fund. Well, let me take a step further back. American Beacon utilizes 3 sub-advisors. So American Beacon doesn't manage the fund. Actually, they hire it out, and it's Lazard, American Century, and Causeway. And each of the 3 sub-advisors manages 1/3 of the portfolio. And typically, these sub-advisors are designed to complement each other. Not that they're in cahoots or they communicate with each other, but it's American Beacon to act like the conductor to make sure all 3 sub-advisors are working in harmony. Back in 2020, American Century replaced Templeton after American Beacon essentially terminated Templeton and selected a 3rd sub-advisor. We felt somewhat comfortable with that change, but the level of comfort never really was warranted or appropriate for the participants. But because American Beacon and this fund specifically had such a good track record, we gave them the benefit of the doubt until the end of last year. And that's where we decided it was time to move on to another more appropriate candidate. And we have produced this document that not only has American Beacon, I'm on page 2, but it also has 3 potential replacements, now on page 3 and 4. One is Vanguard. This is the actively managed international value to complement your international growth, which is managed by Vanguard. You have DFA, which stands for Dimensional Fund Advisors, based out of the Chicago Business School. And then John Hancock Disciplined Value. These are all funds that invest in those international markets. But if you flip ahead to page 5, this is where the performance metrics comparing the 3 potential replacement candidates with the incumbent bear out. The nice thing is we did see an increase in 4th quarter where the top 1/3 of this page are peer group rankings, and these numbers will always be from 1 to 100, with numbers closer to 1 better than numbers closer to 100. You can see the American Beacon, despite the long-term red figures, which means below median, did experience a very, very nice quarter, but I have an explanation for that nice pop in future pages. The other peer group rankings for the other funds you can see on the top 1/3, solid performance out of these 3 potential replacement candidates. And then in the middle and the bottom 1/3 are absolute performance returns over different time periods after their expense ratio has been deducted. So these are performance numbers net of fees. On that bottom 1/3, anytime the fund underperformed an index, it shows in red or parentheses, and you can see the incumbent has struggled quite a bit over those different time periods. Flipping ahead to page 6, the top half of this is the risk versus return scatter plot. And our goal on the upper half of page 6 is to get closest to the upper left as possible. Essential, meaning we're maximizing return without taking incremental risk. Since that's almost impossible, the goal is to get as close to that, and that's called the efficient frontier. You'll notice the Vanguard International shows really, really well on this chart, followed by the John Hancock, and then DFA, and you'll notice that triangle, which is the incumbent, not showing well as expected. Now, with those data points, we flow into the bottom left of that page, what we call the Sharpe ratio, essentially the risk-adjusted return. And so a higher number is good. You'll see a very, very close pack with the Vanguard and John Hancock tied at 0.09, followed very closely by that DFA, and then the American Beacon positive still, but flat to positive. And then moving down into the bottom left, what we do is we take a look at strong markets and see how much of these funds captured on the upside, but we also take a look at weak markets to gauge how much of these funds participated when the markets were weak. And so certainly we like to see above that line a high number and then a low number closer to 0 on the block below the line. And you'll see DFA shows really, really well at 112% capture, but it's also capturing 108% on the downside. American Beacon also is capturing a lot, but it's also capturing down below as well. And then John Hancock at 105 is 100% on the downside. And then more conservative is that Vanguard at 102, followed by the 97% in bear markets. And so no real clear winner on that particular chart, but it's worthy, noteworthy nonetheless. Here is pretty telling. This is the style chart on page 7. What we do is we take a look at the holdings and the performance of each of the funds. Now, granted, this is an international value mandate, but you'll notice the incumbent is exhibiting a lot of growth characteristics. In fact, it's further to the growth side than it is the value. This is another reason this fund has given us pause over the short term. But that performance or style drift, as we call it, is followed closely, very much so, by the Vanguard and the John Hancock. So these value managers are dabbling a little bit more in the growth arena than we would like, but they're still fairly compelling international value funds. What is sticking to the mandate of international value is that DFA, or the green square. So that is more true international value than the others. The next section, and I'll pause and take a breath, is the fee section. What fees are paying in this dovetails in the conversation we just had about the overall economics of the plan. The American Beacon International Fund charges 70 basis points. So I'm in the center, the first line, that percent EXP. This is the fees that that fund manager charges participants, about 0.75%. The Vanguard is 36 basis points, or about 1/3%. DFA is very, very close to that at 37 basis points. And then the John Hancock is a little bit more at 84 basis points. So there's a lot more data points that I can go into. I'll see if anybody has any thoughts, any direction.
Yeah, I have a couple thoughts. I don't want to be hogging the floor all the time, but Brandy said I could talk, so I will. I think if you take a look, step back, and we're kind of set up that way if anybody were to dig into here, but you really have 3 categories of assets. You have your growth, your value, which are on opposing ends, and then your blend that's in the middle. And you see in a lot of investment firms, they'll take the S&P 500, large cap growth, right? And then they'll have a large cap value, and then there might be a blended or a core is what they'll call it, and then you work your way down through the size, right? To me, this is the only one where you're talking, you've got international growth, the Admiral, the Vanguard now, which is a really good fund, and I definitely think it should be there, but it is on the growth side. So if you get another one that leans towards growth, now you've got exposure in the growth area for both funds. So I think if we're going to I think we should replace it, by the way. And I think we should do so with something that's more heavily weighted towards the value side. Now, value tends to be doing a lot better right now just across the board than growth. Growth has gotten hammered, right? The NASDAQ has really taken a bouncing, and it hasn't come back really well so far. So, I mean, to me, I think the two, the DFA and the other Vanguard one, are probably your best candidates.
Do our other committee members have any comments? Or,
I would agree with what Jay is saying. I think the diversity is important.
It was between Vanguard and John Hancock for me, but what really tipped it was the expense. It's just so much larger that it'd be smarter to go with Vanguard.
so from our committee members, we would need a motion and a second to take a vote to replace American Beacon with one of these other funds. Some committee members are thinking.
I would normally say, just based on the numbers, that DFA would be a good replacement, but I am probably more comfortable with the Vanguard. We use Vanguards across the board, and they tend to be very successful. So I'll make a motion to replace Beacon with the Vanguard.
Do we have a second to the motion?
I'll second that.
Then may we take a vote? Ms. Strange?
All those in favor?
Aye.
Aye.
All those opposed? Thank you.
Thank you. We'll move on to our next informational item, which is a review of the International Large Cap Value Fund with HIAS.
Oh, I am so sorry. I jumped
You're-
ahead. I'm sorry, Madam Chair.
That's okay.
I got so excited in my delivery that that's what we just covered.
I thought so, but I
Yes.
was
I'm
just
sorry.
double
Okay,
checking.
yes. No, thank you.
Okay.
I apologize.
Then we'll move on to our legal and regulatory updates.
I know it's under highest, but John, you do a good job about talking about that act that just passed. I'll tee it up if you, is John still on?
He
Okay.
is.
Great. So Secure Act 1.0, it wasn't known as 1.0, but was passed in the waning days of 2019. It caught a lot of the record-keeping infrastructure by surprise, even though we saw it coming. It was a little bit of a surprise. Fast forward to last year, December of, you got it? I can carry this on my own if he's not there. We can't solve for that. Secure Act 2.0 was signed into law December 29th. And there were 120 pages, 90 sections, a lot of provisions. Some had to do with 457 plans, some had to do with corporate plans. Some were mandatory, some were optional. But I do have this somewhat of a cheat sheet that has about 20 of the proposals. I won't go through all of them, or provisions, sorry. But the 5 top ones, and John, please chime in. The first one, and this, I think, got a standing ovation in governmental HR departments around America. It eliminates the unique rule of 457 plan first of the month provision, where to do any contribution changes or enrollments, you have to wait till the first of the next month. That's gone immediately, and that's a mandatory. Even if it was optional, I think every plan would adopt that. The second is eliminates the Roth 457 RMDs. It was this unique structure where I could have a Roth IRA and never have the RMDs like a traditional, but if I had a Roth 457, I did have to take the RMDs. Secure Act 2.0 removed that. That will be effective January 1, 24, so next year, but that's mandatory. The increase in age for RMDs, those required minimum distributions, immediately it goes from age 72 to 73, and then it does phase into age 75 over the decade. And then the higher catch-up limits, it increases the catch-up limits to 10,000 or 150% of the catch-up amount in 2024. That starts in 2025. And then last, and again, I'll turn it over to Nationwide, the decrease in excise tax. Going back to my drum of RMDs, if you fail to take an RMD, the penalty was 50% of the shortfall. That drops to 25%. It drops even further to 10% if the participant corrects within 2 years. So again, a lot of provisions, as you can see, but I won't bore you with the other ones unless you have questions about some of the other ones that you may have heard or read about.
John, do you have anything you'd like to add?
Yeah, can you guys hear me okay?
We can.
Excellent. I lost visual, but yeah, that's an excellent summary provided by Vincent. We're thrilled as a company that these provisions were passed. We lobbied pretty hard on the Hill to get these provisions added, and we think that it is nothing but positives to all participants, especially in deferred compensation plans. Vincent hit the highlights. That first day of the month rule's gone immediately. That was the main provision that we were all looking forward to experiencing. That rule's been in effect since deferred comp plans initially started in the 70s. And we've sure had to work with those for many, many years. And that was a big restriction. And so that restriction's now lifted. So just one other item to note, if you have access to the Nationwide Plan Sponsor Portal, we have what's called a Secure Act 2.0 hub out there that plan sponsors can review. It has all of our information, white papers, articles, webinars. And then participants also have the ability to look at the same information when they log into their website and review the Secure Act 2.0 provisions. But just again, in summary, we're excited about it. We're thrilled. We think it's a win-win for everybody. And those provisions that are in effect the first of next year, we'll obviously review those with our plan sponsors prior to those going into effect. But again, all positives. We're excited. And Vincent, great summary.
Thank you, John. Are there any questions from the committee members or any comments? Then we'll move on to our next item, which is the quarterly employee program reminder.
Thank you. This is just a quick informational item. At the last meeting, it was brought up that we do a lot of our marketing and efforts to get people involved in the deferred comp during the October campaign, and that we don't do as much throughout the rest of the year. So I asked if Greg and Brenda would help me with some marketing materials. And so it's just for to come back because of the comment at the last meeting that we are going to be sending out some marketing material based on what's going on through the year. So we have a lot of retirements in March focused, and so we were thinking that prior to March, we would do an effort to reach out to people that may be retiring, give them a checklist to let them know they can still stay in the plan. And then we would do some other marketing efforts, simply, I'm sorry, here, let me see. And they're just one-page flyers, and they would just be sent out as an email. But Saving Up can add more and talking about just the increasing of $20 to $50 a month and what that looks like in the long run. And then, do you have enough money to retire? And then the checklist that we were going to do for retirees. So with that, I don't know, Greg, Brenda, if you have anything to add to that.
Yeah, so I appreciate you reaching out to me about those. There are certain things that do happen, like you mentioned, throughout the year, and I kind of am familiar with what happens and when. So focusing on our retirees as they all retire at the end of March is, I think, really important to know that they can do lump sum deferrals, they can stay in the plan, and they can reach out to me for support. Then, of course, in May, big open enrollment time. That's a great time to sort of lift people up in terms of, hey, if you're not doing this, let's get you started. I have people all the time that say, oh yeah, I've been here 10 years, 20 years. So we still have a segment of the employees here that we haven't had the chance to help yet. So focusing on that, and then later on in the year using interactive retirement planning tools and encouraging people to increase as they move toward the next calendar year. I love that you guys have auto increase. I think that's a fantastic tool. My personal experience was thinking, hey, I'm getting one of my step raises. I should put more in the plan, but just being busy and not getting around to it. So I love that they can throw an extra $10 in or whatever they want to do every year. So just things to really help people as they plan for the future.
Yep. In addition to that, Human Resources will be having some discussions regarding the ongoing discussion of people leaving the plan when they leave the San Joaquin family. And so we will be coming back with whether we use the exit survey to provide some additional information or how we can reach out to individuals as they are leaving San Joaquin County, whether it's retirement or to move on to another county, for example. So we will bring that back probably next quarter to discuss with the committee.
And I just wanted to, oh, please.
No, go right ahead.
I just want to take a moment, to introduce myself and just follow up. My name is Greg Sabin. I am the new program director for Nationwide in Northern California. I'm taking over for Jake Sowers, who some of you might have worked with. I've been with Nationwide for nearly 18 years, been in the financial services industry for nearly 25. I'm a certified financial planner, a chartered retirement plan specialist. In previous roles, I led our state of California team in terms of their education and outreach efforts. So very excited to be here and working with the county. One quick thing I wanted to mention, on top of the HR efforts in order to educate and update employees, we have an ongoing, let's call it running in the background, we call it the Participant Education Program, which is email, social media advertisements that are targeted towards individuals at where they are in their life path. So, excuse me, nearing retirement, starting to save, mid-savers. So that's running in the background. Those are messages from Nationwide directly, but we know from engagement with our plan sponsors that nothing is more impactful than a message from your employer. So we're very excited about partnering, getting these quarterly messages out, because I think it'll only increase folks' engagement.
I'm sorry, I want to make sure I got your name, Greg? Greg. Hi, very nice to meet you. I just wanted to say, I think that is terrific that what you guys are doing, especially about the retirees, because I don't know if you remember, but last March, $15 million went out the door because people wanted to not stay in the plan. So I think that would be terrific, that you get them before they have that deep thought and like, man, I got to bail. One of the things they had said last year was that when they moved out of state, they automatically thought they were supposed to get out of it because it couldn't transfer state boundaries. So that's nice to know. Thank you.
Thank you. Any other questions or comments on the quarterly employee program reminder? Okay, we will move on. Are there any comments from committee members this morning? I have one comment, sorry, that I'd like to share with the committee. We do have some HR staffing transition occurring, so this is actually my last meeting as the chair. I'm moving to the CAO's office to assist the CAO's team as the other assistant county administrator. So we should have a new HR director in place for the next quarterly meeting. I will be here to assist Jay and the committee as necessary, but thank you for the last 3 years. I appreciate it.
Wow, that was terrific. Do you already have a replacement, or is it still working on one?
The recruitment closes tomorrow.
Oh, okay. Too
We're
late for me, huh?
fast.
No.
So we're not sure yet. We'll let you know once we know. Any other comments? Okay. Ms. Strange, do we have any public comment?
No additional comment.
Okay,
Thank you.
Thank you. Then we will end the meeting. As a reminder, our next meeting is Thursday, April 27th at 10 a.m. here at 44 North San Joaquin Street. Thank you, everybody. Have a good day.